Hello, everyone. You are watching the January episode of First Look ETF. Welcome to Season 6. I'm Stephanie Stanton with ETF Guide. A very happy new year to all of our viewers. We have a fantastic episode to kick off the new year. Coming up on today's show, the resurgence in international stocks is getting more attention these days. We're going to explore an ETF from Eventide Investments that targets this rebounding trend. Plus, we'll tell you about an ETF suite from SS&C Alps that uses a factor-driven, rules-based equity strategy with an emphasis on quality and income. And finally, we'll take a look at an ETF from GQG Partners that blends active management, fundamental stock selection with a risk-aware philosophy. All of it inside a single ticker. But first, before we go any further, let's welcome Maital Legum with the New York Stock Exchange. Maital, thank you for joining us. Happy 2026.
Thanks, Stephanie. It's great to be back for the first episode of 2026.
All right, let's kick things off with the latest update on ETF launch activity. How are things shaping up?
As we closed out the year, the industry is inching towards 5,000 ETFs in the U.S. market, a milestone that speaks to incredible growth. Here at the New York Stock Exchange, we're proud to say that about 75% of all U.S. ETF assets under management are listed right here. December alone saw 135 new launches, capping off a year of unprecedented product development. In total, the market welcomed over 1,100 new ETFs, smashing all previous records. And it wasn't just ETF launches. ETF inflows hit nearly 1.5 trillion in 2025, averaging about 6 billion a day. That's another record for the books. With innovation and investor demand at an all-time high, ETFs continue to redefine the marketplace. And I certainly can't wait to see what this year has to bring.
Last year was a remarkable year. The ETF industry hit many big milestones. For 2026, what trends in the ETF marketplace are on your radar?
Active ETFs continue to surge. In fact, they captured nearly a third of all inflows last year and now represent a majority of new launches. Expect fierce competition on performance and fees. After many years of waiting, this year, multi-share class ETFs become a reality, giving issuers new flexibility in structuring products. We also see cash-like ETFs remain in high demand as investors seek safe haven with ultra-short treasury and money market fund-like ETFs setting new records. Defined outcome strategies, adoption-based ETF, are also booming. Covered calls and derivative overlays are attracting investors looking for income, even more complex structures. And finally, crypto ETFs enter a new phase. With streamlined SEC guidelines, we could see over 100 new launches, including multi-coin products, though we're likely to see crowding and consolidation in that space as well. The future for ETF continues to be bright. They've truly become the wrapper of choice with strong retail adoption and innovation driving the next wave of growth.
And Maital, we have a great guest lineup, as always. What are you looking forward to on today's show?
First up, we have Alps O-Shares, who made headlines late last year by bringing 4 of their funds back to the NYSE. Always great to see that kind of commitment to our marketplace. Eventide joins us, bringing their unique investing in good approach to the ETF space. And rounding out the lineup, GQG Partners, a boutique investment manager that recently debuted their first ETF. With innovation and fresh ideas from these issuers, today's conversations are going to be insightful and forward-looking. Stay tuned, you won't want to miss it.
And we're going to wrap it up right there. Maital, thank you so much for the update. Keep up the good work, and we will see you very soon.
Thank you.
And just a quick reminder to watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. Also, we simulcast First Look ETF on iTunes and Spotify, so don't miss it. The Alps O-Shares suite of ETFs is one of the more unique ETF lineups. To select stocks, the funds use a rules-based and factor-driven strategy with an emphasis on equity income, quality, and minimal volatility. Well, here to tell us more, along with recent changes in the lineup, is Paul Baiocchi, head of fund sales and strategy with SS&C Alps Advisors. Paul, always a pleasure to see you.
Always great to see you as well, Stephanie.
So your firm recently transferred the listings of 4 Alps O-Shares ETFs to the NYSE ARCA. Explain why this was done and then what impact it will have on ETF shareholders.
Yeah, so the most important venue for trading securities of any type in the world is the New York Stock Exchange. They've been an incredibly important partner to us for a couple decades now. And this is really just about optimization of our business and of our lineup. And given that the NYSE ARCA is home to some of the most important products and securities in the world, it was a natural way for us to continue to provide the appropriate venue for the allocators who interface with Alps products on an ongoing basis. Just anecdotally, we were there last year to celebrate the 15-year anniversary of AMLP, our largest flagship ETF. And it was an experience that was meaningful to me, having been in the industry for a long time, but also was a really important opportunity for us to engage with our clients at a very important place in financial services.
Yeah, absolutely. Let's take a deeper dive into this lineup, the Alps O-Shares lineup. You've got these four products inside of it. What makes it a compelling solution for ETF investors? And maybe, give us some nuggets of some of these four products.
Yeah, so OGIG, the Global Internet Giants ETF, is kind of the one sore thumb, if you want to call it that, within the lineup because it's distinct in terms of what it's trying to do for investors. And so I'll just focus on the quality components of the lineup. OEFA, the developed ex-US version, as well as the small cap version, OUSM, and the large cap version, OUSA. And ultimately, what all of these products are trying to do is take a segment of the market and improve the overall quality through screening for things like return on assets. So are you able to generate profitability on your asset base? Net debt to EBITDA. So are you able to generate that profitability without excess leverage? And then also make sure that the portfolio doesn't have a vicious drawdown profile and doesn't have significantly higher volatility. And so if you're looking at large caps, if you're looking at small and mid caps, if you're looking at developed ex-US stocks, what the O-Shares lineup does is take that universe, that starting universe, which is made up of a number of different types of companies in different sectors, and ensure that the companies you own have profits that are generated without excess leverage. They pay a dividend, they grow a dividend, and they have low relative volatility. And so at its core, the strategies do exactly what they say they do in their name, which is quality dividends. So quality companies with a strong dividend profile driven by really their ability to grow their dividends over time and cover those dividends.
Yeah, obviously back to basics, right? So how do you see advisors and investors using these ETFs as part of an overall investment portfolio strategy?
The way we try and message the O-Shares lineup to investors is, are you looking at a segment of the market and trying to take on an allocation, but are not necessarily trying to take the full risk of that allocation? And I think OUSM is a great example of that because, as you know, off of that tariff tantrum bottom in the spring of last year, we saw quite a rally in small caps. And out of the COVID bottom, we saw quite a rally in small caps. But it was often led by the lowest quality companies in that universe. Companies that don't generate profits. 40% or so of the Russell 2000 famously doesn't make money or is unprofitable. And those are the types of companies that are excluded from OUSM. And so OUSM is never going to promise to give you full participation in a rally like that. But what it's also typically done historically is avoid the violent drawdowns that come in that segments of the market, in many cases without warning. And so some drawdown protection, drawdown avoidance, but also ensuring that when you're allocating on a core basis to large caps, to small caps, to developed ex-US, that you're doing so with a portfolio that's been culled down based on that factor methodology to ensure that those companies generate profitability without excess leverage, pay a dividend, grow their dividend, and have dividends that are well supported by fundamentals. And that is really the core philosophy. This is a way to take the market and orient it toward that quality factor while also ensuring that you get a dividend profile that is also well supported.
Good stuff. We are going to leave it right there. Paul, it's great to see you again. So happy to have you join us here on First Look ETF, and good luck to you.
Always a pleasure. Thank you so much, and you have a great year.
After more than a decade of U.S. dominance, global equities have quietly flipped the script. Over the past year, international markets have begun to outpace the S&P 500, powered by cheaper valuations, improving economic sentiment abroad, and a rebound in regions like Europe and China. We're here to discuss that, plus a new ETF targeting this area of the global stock market is Chris Grogan, Portfolio Manager, Director of Asset Allocation Services with Eventide Investments. Chris, thank you so much for joining us.
Thanks, Stephanie. Thanks for having me.
You're very welcome. Before we launch into your latest ETF, please familiarize our audience with Eventide Investments and what makes your firm's investment approach unique.
Sure. So Eventide Investments, we've been around for 17 years. We manage roughly $7.5 billion in assets across our mutual funds and ETF business lines. We've been a thought leader in the faith-based investing movement. I think when folks think about faith-based investing, they typically think about maybe a restricted list or a Catholic screening approach. We've been at the nexus of implementing an investment philosophy that seeks to, our tagline is investing that makes the world rejoice. And so what does that mean? As a faith-driven investors, we try to avoid profiting from many different issues, the big obvious ones related to addiction and the destruction of life. But we've also implemented this investment philosophy where we believe as a way to love our neighbors, we're seeking businesses that are loving their neighbors, and we interpret that as a company's stakeholders. So we take a particular focus on employees and customers as the primary stakeholders in a business, but we also consider other stakeholders. And we're doing this in a way to achieve, of course, our mission that's driven by Christian values and the ethics behind that. But we also believe that value creation is an underappreciated source of alpha in the marketplace. And so we've grown from this kind of boutique shop. Our primary our kind of legacy competence is in the high conviction fundamental active strategies. We have a particular expertise within the biotech space. But since we've entered the ETF business line a little over a year ago, we've expanded our offerings to include other factors like dividend growth, mid-cap, but also your typical style boxes. And now our latest creation, if you will, is our first ex-US mandate in this international ETF.
And let's dive into that. The Eventide International ETF, your ticker is ESIM or ESIM. Recently joined your ETF lineup, as you said. The fund is listed on the NYSE ARCA, so big congrats on that. ESIM targets international stocks, and you guys had a solid 2025 by outperforming U.S. stocks. Tell us more about the investment strategy behind ESIM and then what types of companies it might hold.
ESIM, it's within our systematic lineup. And what does that mean? It means we use rules-based portfolio construction to implement the investment philosophy. And that's really useful as we look at international markets. It's a very, very broad universe. There's some international indices that have, between 8,000 or, more than 10,000 securities. And so using a rules-based, quantitatively driven way to implement portfolio construction is a great way for us to try to derive alpha from our curated list of securities that our fundamental and values-based analysts have, selected for inclusion in the strategy. We just launched the strategy, or the ETF, if you will, a few weeks ago. And so the ETF is in its infancy, but we spent a considerable amount of time vetting that universe, and we consume a lot of data from external vendors, and we do our own web scraping, and we have our own team of programmers and developers that help to kind of build that view of a company and how its products and practices impact human flourishing and their stakeholders. We call that process Business 360. And so as we think about the strategy, we educate our allocator clients to think of it as a Business 360 factor strategy for international markets. And in its current state, it's roughly 100 holdings, and it's pretty relative to ex-US ACWI mandates. It's skewed towards developed markets, but it has some developing emerging markets exposure. We don't have any exposure to China, which our values-based or faith-based audience tends to appreciate.
Okay, so then on that note, how do you see financial advisors and investors potentially using ESIM inside a diversified portfolio?
We do a lot of work on consulting with financial advisors that are using Eventide-only strategies or a combination of various managers to build values-based or faith-based portfolios for their clients. We've observed that within this kind of ex-US international mandate, there's a lack of options for the very discerning values-based investor, especially if they're very cost-conscious. We priced this strategy very aggressively at 59 basis points. It's our, in our observation, we've seen international mandates are typically used as, if you look at the average allocator as a beta exposure. Of course, can be significant opportunities for alpha if the allocator has a high conviction view. Usually, very often we find that in emerging markets. But for your average allocator, they're typically, if they're for a U.S. based client, they're overweight U.S. equities, and their international allocation is typically on average 20% of their equity allocation. So we wanted to serve that beta-like client by using a systematic approach that seeks to reduce tracking error as much as possible, but doesn't violate a lot of the discerning screens we have on areas of avoidance, as I mentioned, addiction and destruction of life issues, and we wanted to give them a compelling story for their clients. So instead of picking an ESG aware or very light touch screening strategy, or that's typically packaged in a direct index, we want them to bring investing that makes the world rejoice to their total client portfolio. And until we've launched a strategy that they've many of our clients have just stopped short of saying that holistically on a portfolio level, we're seeking to find best in class companies that are contributing the most to human flourishing. And so now they're able to do that with this strategy that enables total portfolio solutions that implement our investment philosophy of investing that makes the world rejoice.
Yeah, making the world rejoice. We could all use a little more of that. Chris, thank you so much for joining us and sharing more about your latest ETF. Good luck.
Yeah, thanks so much, Stephanie. Appreciate it.
Managing downside risk while still delivering attractive long-term returns over a full market cycle is no easy task. The GQG US Equity ETF and your ticker GQGU could be a compelling solution for ETF investors. Here to tell us more about the fund and its unique strategy is Alex Hoy, Client Portfolio Manager with GQG Partners. Alex, thank you for joining us today. So before we dive into your latest ETF launch, can you familiarize our audience with GQG Partners and tell us about your firm's investment philosophy?
So GQG Partners was founded in mid-2016, and today we are very grateful to be running roughly $160 billion on behalf of our clients. Our four main strategies are our U.S., international, emerging markets, and global equity products. And our new ETF, GQGU, is the ETF vehicle for our U.S. equity strategy. Our unique investment philosophy is this concept that we call forward-looking quality. And it's our belief that you can't invest with simply an eye in the rearview mirror. You have to invest with an eye to the future and identify companies that are exhibiting high-quality characteristics that will enable them to compound their earnings on a go-forward basis instead of just looking at their history and assuming that that will play out as it once did.
The GQG US Equity ETF and the ticker, again, GQGU, was recently listed on the NYSE ARCA, so congratulations on that. So how does the fund select stocks and what types of companies might we expect to see inside the portfolio?
Our investment process is entirely focused on bottom-up stock selection. So using that investment philosophy of forward-looking quality that I already discussed, our investment team is out there meeting with management teams and looking at companies one by one to add to our portfolios. But in terms of what types of stocks you may find in our portfolio, we are a benchmark agnostic strategy, and this investment philosophy gives us the ability to be really adaptable into whatever area that we are finding attractive opportunities at that point in the market. So sometimes we may look like more traditional growth managers, to use the typical style box terms. And sometimes we may look more value oriented based on our assessment of companies exhibiting attractive earnings growth potential on a go forward basis.
So Alex, how do you see financial advisors and investors potentially using GQGU inside a diversified portfolio?
It's a great question, and it's one that's sometimes difficult to answer because our historical performance pattern has been one that is quite strong, but it's been notably one where we generate a significant portion of our alpha in down market periods. And we're really proud of our downside protection historically. But that said, we don't ignore the upside. We typically keep up in upmarket periods. And so the way that folks use us in the equity buckets within their portfolios can vary from time to time. We do see a healthy amount of clients pairing us with maybe a passive index option where we are in a 50-50 split, or maybe the satellite to a core passive allocation, just because our investment approach is one that does tend to move around, or rather the portfolio does tend to move around. But we all are also commonly used as a growth manager within a client's portfolio. But in these instances, clients need to understand that we're not always going to look growth in the style box sense of the word, but we are of course looking for companies that are growing their earnings. And so in that approach, we really do need clients to understand that it may take a full market cycle for our investment opportunities to play out. So keeping that long-term focus in mind is important.
And we're going to end it right there. Alex Hoy, thank you so much for joining us. It's been great to have you here on First Look ETF. And that does it for today's episode of First Look ETF. If you enjoyed the show, please tell us in the comments section below and by hitting the like button. Want to give a big thanks to all of our guests, along with Maital Legum at the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you next time.